Hey traders, just trying something a bit different here today. And doing a YouTube live. I want to walk through a quick strategy that I like to do on stocks that have upcoming earnings. So it's called a diagonal put spread. And the basic setup is we want to choose the first expiration after earnings. So I think Tesla has earnings on maybe April 23rd. I want to go to around the 15 delta and I want to sell that strike. That's my short strike. Then I want to go out 2 weeks in time, so May 10th, and I want to find an option trading around about the same price. In this case, it's the 150 put, so just slightly lower than where we're selling. And I'm going to buy that one. So selling that one, buying that one. The cost of the trade and the max risk on the upside is the amount that I pay for the trade. So 250 minus 220 times 5 contracts. That's our max risk on the upside. On the downside, the max risk is the difference in the strikes times the contracts times 100. So 5 times 5, 25 times 100, 2,500, plus the 50 odd dollars that we're paying, or $30 per contract. So that's our max risk on the downside. We start off more or less delta neutral, little bit of a delta, a positive delta of 6. You can see our T+0 line is fairly flat. We've got very little risk on the upside. Tesla can go all the way up to 190, 195 tomorrow, and we don't really lose anything. We've got a little bit of risk on the downside in the short term. If a big drop comes early in the trade, we're going to lose a little bit. But if I change that T+0 line to be, that's our expiration date there. There's earnings. If we say we're going to close this out the day before earnings, say April 22nd, you can see the trade's looking really good anywhere in this zone here. So really anywhere between 150 and about 190, which is a really wide range for Tesla over the next 10 days. And we're just going to pick up a little bit of time decay. You can see here we've got $38 per day in theta. We're slightly positive Vega, and we're taking advantage of the option skew. So we're selling the higher vol option and we're buying the lower vol option. Max gain is about 2,300, max loss 2,500. We're not aiming for this max gain. We're really not aiming for anything in this top half of the triangle. We're really just looking for, $250 to $500 gain. Somewhere around here would be ideal for this particular trade. So ideal scenario is Tesla around 160 to the current price, about 175 in about 10 days time. So somewhere in this zone here, and then we'll look to close it out before earnings. If you've got any questions on that, feel free to give me a shout. Best of luck with your trading, and we'll talk soon.